In a well-diversified developed market such as the US equity market, a broad-based equity market index such as the S&P 500 index provides investors with a reasonable spread of investments across a wide range of companies, sectors, industries and even geographies. However, in the case of a developing or emerging market such as South Africa, this is not necessarily the case. The history of the South African stock market stems from the mining industry, particularly gold mining. It is therefore not surprising that the makeup of the JSE has always been and continues to this day to be dominated by mining and resources companies. In general, resource-based investments are much riskier than financial and industrial investments. The volatility of the major drivers of resource companies, such as commodity prices and exchange rates, result in elevated levels of risk, which is often beyond the appetite of investors, such as pension funds or more conservative individuals. Also, in line with international trends, many South African companies have globalized quite extensively, to the extent that not only have they externalized their earnings base, but the share prices of many of our mega-cap stocks are now also set in international stock markets by foreign investors. These structural factors result in some significant concentration risk in what should be a broad-based market index. The Top 40 Index, also known as the TOPI, is an index of the 40 largest and most prominent companies listed on the JSE as measured by size or market capitalization. The contribution or weight of each share to the index is based on the free float or available market capitalization. When you look at the distribution of weight through the 40 constituents of the Top 40 Index, it is quite clear that it is dominated by a few big names. BHP Billiton, Anglo American, SAB Miller, MTN and Sasol jointly make up almost 50% of this index. That means that for every 100 Rand invested in the top 40, almost 50 Rand will be spent on just 5 companies. At the tail end, the 10 smallest companies will not get much more than 5 Rand to spend between them. The introduction of equal weighting to the same constituents is a remarkably powerful adjustment that reduces the size, sector and risk factor concentration in one easy step. It is a methodology that has been applied internationally for many decades with great success, as it provides similar returns than market cap weighted indices, but at much lower risk. Over the longer term, this improved risk-adjusted return is definitely to the benefit of all investors, regardless of their risk appetite. This very attractive feature is what is readily available to investors in our Beta Beta equally weighted Top 40 ETF, the BBET40.